Hey everyone, let's dive right into this explainer. If you're gearing up for an exam on direct tax laws, you already know that the assessment of trusts, institutions, and political parties is just a massive, heavily tested area. Honestly, it can feel like an absolute maze of sections and subsections that are literally designed to trip you up. But don't worry, we're going to navigate it together. This explainer is built specifically to help you master the crucial differences in taxation for trusts and political entities. We're taking all that dense legal text and breaking it down into clear, visual concepts, so you can walk into that exam room with absolute confidence.
So, here is our agenda for this review. First, public versus private trusts. Second, the two tax regimes. Third, Section 11 exemptions. And finally, number 4, political versus electoral entities. Let's get to it.
All right, up first, Battle 1, public versus private trusts.
Now, before we even touch the specific tax sections, we have to understand the core structure of a trust. And really, that all comes down to understanding who actually benefits from it. Take a look at this comparison. On the left, we've got public trusts. These are created for the benefit of the public at large. Because of that, the beneficiaries make up a body that is incapable of being ascertained. You simply can't point to a specific closed list of names. But on the right, we have private trusts. These are usually set up for the convenience of specific individuals or families. So the key differentiator here is ascertainment. Public trusts serve an unascertainable general public, while private trusts serve specific, known individuals that are capable of being ascertained.
And guys, this clearly illustrates exactly why this distinction matters so much for your exam. If you get a scenario that describes a private trust, you can just stop right there. Private trusts do not enjoy tax exemptions under the Income Tax Act. All those philanthropic, tax-exempt benefits we're about to dive into, they apply specifically to public trusts.
Moving right along to Battle 2, the two regimes.
Okay, assuming we've got a qualifying public entity, say a charitable organization or hospital, the government obviously wants to encourage their philanthropic work. But they organize the tax breaks into two completely separate lanes. The first regime operates under Section 1023C. This is kind of the narrow lane, generally reserved for very specific institutions. Then you have the second regime operating under Section 11. This one is much broader in scope. In fact, it's the more popular and widely adopted route for nonprofit organizations holding property in trust wholly for charitable or religious purposes.
If you see this on your exam, I want you to use this mental map. General charitable or religious trusts, they almost always fall under Section 11. But if a question specifically calls out a university, an educational institution, a hospital, or a medical institution, your brain needs to immediately jump to the specific clauses of Section 1023C. Just keep those two lanes neatly separated in your head.
Next up, exemption conditions under Section 11. Claiming these exemptions isn't automatic. Trusts also have to meet strict registration requirements under Section 12. Let's look at the compliance checklist they have to follow to actually keep that Section 11 exemption.
The absolute golden rule here is application. The income must be applied wholly towards its intended charitable or religious purpose. Period. Second, those activities generally have to be conducted right here within India. And thirdly, and pay attention because this is a big one, the exemption will be entirely denied if the income is used to benefit a prohibited category of persons. So, let's define exactly what that means.
Notice the hard numerical threshold on this one. Under Section 13.3, a prohibited person includes the author of the trust, a trustee, or their relatives. But look at that contributor line. Any contributor who gives a total amount exceeding 50,000 rupees instantly joins that prohibited list. The trust absolutely cannot use its income to provide a benefit to them, or it risks losing its Section 11 exemption entirely.
But wait, there is a highly testable exception to this rule under Section 13.4. What happens if a trust invests its funds into a business concern where one of those prohibited persons happens to have a substantial interest? Do they lose all their tax exemptions automatically? Not necessarily. The magic number you need to remember for your exam is 5%. The exemption is not entirely lost if that investment does not exceed 5% of the capital of that business concern. This is just a brilliant illustration of the nuance in the law. If they stay right at or under that 5% investment threshold, the penalty is completely isolated. In that specific scenario, only the income generated from that minor investment gets taxed. The rest of the trust's broader income, it stays safely exempt under Section 11.
All right, on to our final matchup, Battle 3, political parties versus electoral trusts.
We are pivoting away from charities now to look at how the tax code handles the flow of money in politics. We're contrasting Section 13A with Section 13B. Section 13A deals with actual political parties, the entities that campaign, run candidates, and really operate in the political arena. Section 13B, on the other hand, deals with electoral trusts. Think of these essentially as nonprofit companies created specifically to receive voluntary contributions and then distribute them to political parties. They are conduits, not campaigners.
Let's zoom in on political parties under Section 13A for a second. The law says a political party doesn't have to pay tax on income from house property, capital gains, or voluntary contributions. But, and this is a massive but, they must rigorously adhere to a 4-step compliance checklist. They've got to maintain proper books of account, have those accounts audited, submit a very specific report detailing contributions under Section 29C of the Representation of the People Act, and file their return of income before the due date. If they fail on even one of these, poof, the exemption vanishes entirely.
Okay, let's put this into practice with a computation scenario, exactly like a puzzle you're going to see on the test. Let's assume all conditions are met. Standard voluntary contributions, electoral bonds, and rent received from a property are fully exempt. That's great. But notice the taxable column? If a party accepts cash contributions exceeding 2,000 rupees, like these 2,100 rupee donations shown here, that entire amount becomes taxable. Furthermore, if the party runs a standard business, say a cafeteria in their headquarters, the net profit from that business is fully taxable. It's a great example of how that tax umbrella definitely has some holes in it.
So as we wrap up this explainer, I want to leave you with a question to really test your knowledge. Based on the hard thresholds we just covered regarding Section 13, what happens if an auditor finds a trust has invested 6% of its funds into a trustee's private business? Think back to that 5% rule we discussed earlier. How would that single percentage point over the limit change the entire tax assessment of the trust? Think about it, review your notes, and you're going to be one step closer to absolutely acing your exam. Thanks so much for joining me on this review.